We're talking about Al Broaddus, who was president of the Richmond Fed Bank from 1993 through mid-2004 when Alan Greenspan was Fed chairman. Al, great to have you back with Matt and myself. So pretty much got what you expected from the Fed today?
Well, the language was a little different, but I don't think it was terribly surprising, and many of the important points have already been made. The key thing is that phrase about inflation. That's what's really different. Inflation has been drifting down. Inflation expectations have been drifting down. But this is a much stronger statement or recognition by the committee that the inflation rate is now well below its, or at least below its desired level. And then, of course, there's that additional language that says that if they need to deal with this through a more accommodative policy, they'll do it. That phrase is actually not new. If I'm not mistaken, something very close to that was in Ben Bernanke's Jackson Hole speech. But again, the real story here is that there seems to be, there may be some internal politics, as you've mentioned. There may be some internal dynamics going on here, but it does seem to signal that the Fed is more concerned, maybe not greatly concerned, but more concerned than it's been about the risk of moving towards deflation.
Al, do you think that the Fed, that Ben Bernanke needs to come out and give an explicit inflation target? There have been many people calling for that for years, really.
Well, you know, a lot of us, I'm one of them, think that over time that would be a good thing for the Fed to do. I don't expect anything like it. He pretty flatly dismissed that, as I recall, in that same Jackson Hole speech. So I don't think we're likely to see a number. I mean, but this statement does say that they would like to see the inflation rate higher. We know now it's just above zero, so that would suggest that they're looking for something like a 1.5% annual rate of inflation as an optimal rate.
Al, where do you think we are right now in the economy? Do you feel like that we are starting to see things gently improve, if you will? We've had some more upbeat economic reports as of late.
Carol, I think we are. I think the recovery is occurring. Of course, the NBER yesterday, I guess, said it's been going on now for about a year. It's not. It's hard to find it sometimes. But I think it is occurring. An analogy I like to use is the economy's healing. It's taken a big hit, and it's taken some time to get things moving. But I do think it's healing, and I think you can see that in some of the numbers. But you know, there's just a big adjustment process that has to go on now in credit markets, on household financial balance sheets, ordinary household balance sheets, to get the traction for it to accelerate and continue. And there is some downside risk, and I think the fact that there is some downside risk is what was really signaled here today.
To me, it sounds like you're saying we just need to be patient here. It's going to take a while to work all this off, and we just got to let it ride it out. If we believe in economic cycles, we need to just let it do its thing.
That's exactly what I believe. I mean, the Fed needs to, if there are clear signs, perhaps in the inflation or inflation expectations data, that the deflation risk is rising, then at that point the Fed will need to act decisively. But I don't think we've seen it quite yet. And you're right. I think we need to leave things alone as much as we can and let the economy take care of itself.
If there is a need for the Fed to come in and intervene again, do you think that Ben Bernanke can get some serious bang for his buck? I mean, do you think they still have tools left to really move the economy?
I do, Matt. I think QE is a tool, and I think it will work. What is tricky is that we don't have much experience with it. We've had one round of it, know a little bit, but not a lot. So you really don't know exactly how much you need to do or how long you need to do it in order to get the economic result that you want. So, you know, it's not as neat and nice as conducting monetary policy in a more normal environment when interest rates are at a higher level, and you can use interest rates, as we traditionally do, to change our policy settings. But we certainly are not, the Fed is certainly not out of ammunition. This is a powerful tool, and I'm sure that they'll use it if they need to.
Hey, you know, earlier today, Al, Alan Meltzer, he's a historian of the U.S. Central Bank, he was on our air, and he said the Federal Reserve is too focused on short-term results and maybe considering the pursuit of flawed policies. He talked about, you know, further expanding of the balance sheet. He's saying we don't have a monetary problem. We have a $1 trillion or more in excess reserves. So it's literally stupid to say we're going to add another $1 trillion to that. What's your response to what he's saying?
Well, I know Alan, and I have a lot of respect for his views, and he's right. The Fed does need to have a longer-term view in mind. And I have little doubt that Bernanke and his colleagues do. I don't think you can ignore the short run in the sense that if a deflation cycle were to get underway, I'm certainly not expecting that. I think we will not have that. But if something like that were to become apparent, then the Fed needs to act to preempt that, because if we go back into an economic hole, the costs are tremendous, and it's going to make it all the more difficult to do the kinds of things we need to do with monetary policy and economic policy generally over the longer term. So while you need to have a view on you need to be aware of the longer term risks. Sooner or later, this thing is going to have to reverse course. The Fed will have to reverse course, and it needs to be prepared. But right now, I think the focus on the short-run risk is not inappropriate. I think it's appropriate.
I think that's all we have time for.
Do we have 45 seconds left,
We
guys?
have 45 seconds
All
to
right,
break.
We got to say goodbye. Al, thank you so much. Al Broaddus, former Richmond Fed president, walking us through that Fed decision and statement today.